Welcome to our new ONFIF series, where we'll be interviewing some of our ONFIF experts on the latest actions and activities of key central banks around the world with regards to the economic and financial consequences of COVID-19 pandemic. Today, we'll be looking at the Bank of England, reviewing what their response has been since the outbreak, what are the tools at the bank's disposal, and what are some of the challenges as we look towards the recovery. Today, I'm very pleased to welcome Denai Kirikopoulou, our Chief Economist and Director of Research, and Chris Papadopoulos, an economist here at ONFIF. Welcome. Chris, if I turn to you first, you've been a keen expert and analyst of some of the measures that the Bank of England has put forward to keep businesses afloat and people in jobs to minimise the long-term damage of COVID-19. The new Governor, Andrew Bailey, has started his role at the bank at the most unprecedented time. Can you tell us a little bit more about some of the main responses of the bank?
Thanks, Martin. Yeah, so the Bank of England was, of course, accused of doing too little in the last crisis, but this time around, Andrew Bailey has really pulled out all the stops. The bank has opened its doors to financial institutions so they can borrow all they need, and there is no suggestion anymore of moral hazard. They've restarted asset purchases. ONFIF's policy tracker on our website shows that asset purchases have been going at about twice the rate compared to the previous crisis. It's also trying to do a lot more this time to get money to non-financial companies, lending to them directly and offering incentives to banks to lend to them. And to keep lending going, it has also told banks to use up their capital buffers, which they've spent the last 10 years building up.
Great, thank you very much. You mentioned Andrew Bailey as the governor with his experience of having to deal with the previous crisis. How do the responses of the bank compare exactly to 2009 to 2007 to 2009 financial crash? The nature, the origin of the crises are different. The previous one was rooted in banking and finance. This one is a health crisis, but with very significant economic consequences.
One aim here, especially early on, was to prevent the COVID crisis from becoming a financial crisis, which they did achieve after some market turbulence in March and April, when there were stock market declines and bond yields did spike. Things have settled now a bit, at least in developed markets. There is still some trouble, obviously, in emerging markets. There was also a view last time around that central banks had a lot more room to act than treasuries, and treasuries needed to deal with, and finance ministries needed to deal with large budget deficits and government debt. This is now the other way around. So central banks have essentially run out of room in the eyes of a lot of people, and treasuries have a lot more room to do more than they did last time. So central banks have really been playing a more supportive role rather than trying to boost aggregate demand directly. And that makes sense as well, because this is something, as you said, it originates in the real economy and spills over into finance, whereas before it started in the financial sector and then spilled over into the real economy.
If we turn to Denai and the topic of negative interest rates, we've seen negative interest rates in Europe. It's clearly a legacy from the previous financial crash. And in the Bank of England's 324-year history, the bank has never used them. But in a surprising U-turn about 2 weeks ago, Andrew Bailey mentioned that the bank was eyeing to introduce them to stimulate an economic recovery. How plausible is this option, and why is the bank considering this measure?
This is an unprecedented crisis, and I think it calls for a review of what measures may be available. And as we heard from Chris, central banks are reaching the limits of their toolkits in terms of having used quite a lot already in the previous crisis. So it makes sense that central banks are now looking at what are the next options for them, and negative interest rates could be the next frontier of the Bank of England. That doesn't make it likely that they will use it, because as we heard, it's a crisis that calls primarily for a fiscal response and also for more targeted response. So central banks are the support act here, and they've already done quite a lot. I think the issue to think about with negative interest rates is central banks have a mandate of inflation to look at, And there are structural factors that are keeping inflation low and negative and rates at very low levels. So they're more of a symptom of the economic situation that we're in rather than a solution to it. But the way they're meant to work is to disincentivize banks for keeping money at the central bank and instead to lend it out to the economy. Now, that would, even if that were to filter through and there were more lending and spending, that would support the demand side of the economy. What we're seeing now is a supply shock primarily. It's also a demand side shock. So they wouldn't be as effective as more targeted economic responses to the crisis. And there are also risks associated with going to rates or negative rates, which are very present in this current crisis. So, for example, there are risks to banks, which at the moment are very much hurt by loan losses because of the crisis. There are risks to financial stability because if there are no returns in that area, asset owners and investors may be pushed to more risky assets, which may cause financial stability risks in the future. So because of all these risks, I think the Bank of England will think twice before it goes into negative rates. But I think it's right for them to review all the tools in their toolkit.
Thank you. Chris, turning back to you and the theme of recovery here. UK and across Europe, we've seen easings on lockdown measures. Plans are being set up for a return to a seeming form of normalcy. However, this comes with its own sets of challenges and issues. What are some of the problems and challenges that the Bank of England is going to face, moving forward?
Well, banks, there's been things like mortgage holidays, and obviously a lot of businesses will have difficulties servicing their bank loans. So banks will have a lot of non-performing loans. They've been told to use their capital, so they will need to recapitalize at some point. So the Bank of England will need to manage that process carefully so that lending to the real economy isn't significantly less than it would be otherwise. There is also a debate going on now about whether the current fiscal monetary coordination is going to lead to inflation down the line. Obviously, there were inflation warnings during the last crisis, which didn't come to fruition. They were wrong. The difference this time is that the amount of money held by the private sector is going up quite rapidly. On the flip side, of course, commodity prices have collapsed everywhere and unemployment is high, which suggests deflation is more likely. But if inflation does go up and the bank does find itself in a low growth, high inflation scenario with demand driven largely by fiscal policy, it will have to decide whether to tolerate higher inflation or whether it wants to raise interest rates and sacrifice some growth. And the challenge will be trying to navigate in an environment where there's something called fiscal dominance, where central banks struggle to control inflation and demand because fiscal policy has taken such a leading role.
Excellent. Thank you very much, Chris. Thank you very much, Denai. That was very interesting and very useful. If you're interested in more information about what central banks have been doing over the past few months and weeks, please tune in to our next videos. Please also follow us on our website, www.omfif.org. And we also have a new central bank policy tracker, so please check it out as well on our website. Thank you.